Hey everyone, and welcome to today's Explainer. Today, we're going to break down 3 high-quality AI companies that you should be watching really carefully, rather than frantically chasing. You know, if you've been following the market at all lately, you know the AI narrative is just dominating the conversation right now. But actually separating the real money-making businesses from the pure momentum plays, well, that requires taking a bit of a step back. Be honest, are you getting totally exhausted watching these speculative names rocket up only to pull back incredibly hard? If so, you are definitely not alone. And the good news is we have a much better strategy to discuss today. Look, it's incredibly tempting to jump in when you see a stock shooting to the moon on big AI promises. But buying at those temporary euphoria peaks almost always leads to some pretty painful drawdowns. We want to avoid that whole roller coaster entirely. So instead of jumping on speculative rockets that often crash and burn, we're going to focus on established businesses. We're talking about companies with real, tangible revenue, deep competitive moats, and, hey, actual dividends. We're essentially shifting our entire mindset from the fear of missing out to patient accumulation. We want companies pumping out massive free cash flow that we can comfortably hold for years to come. All right, here is our roadmap for today. First, we'll talk about escaping that AI hype. Second, we dive into Microsoft, our enterprise AI leader. Third is Alphabet, covering search and cloud. Fourth, we'll look at Broadcom, the infrastructure engine. And finally, we will wrap it all up with our practical watch, not chase playbook. Okay, let's jump right into part 1, escaping the AI hype and building a fundamentals-based watch list. So, what does patient accumulation actually look like? Well, it means doing our homework right now. We identify the exact cash-generating companies we want to own, and then we simply wait. Instead of buying at those crazy euphoria peaks, we let the market's inevitable overreactions become our perfect entry points. It's all about letting the game come to you. Moving on to part 2, we have Microsoft, the enterprise AI leader, and the platform that's actively converting investment into recurring revenue. Let's ground ourselves in some reality here. $331.8 billion. That is Microsoft's approximate revenue projection for fiscal year 2026. Think about that scale for a second. They aren't just talking a big game about AI, they are generating hundreds of billions of dollars while deploying it and maintaining an absolute fortress of a balance sheet in the process. They are taking the massive costs of building out AI and converting them into reliable, recurring revenue. I mean, think about it. They've got Azure doing the heavy cloud lifting, Copilot integrating directly into the daily workflows of millions of people via Microsoft 365, and these massive broader ecosystem effects across their security products and developer tools like GitHub. And you can actually see this tangible demand shift playing out in the numbers right now. Azure's growth rates have been pushed from the mid-30s all the way up to around 45% in certain periods. And that is driven entirely by surging AI workloads. Enterprises aren't just running cute test pilots anymore, right? They are moving to actual full-scale production, and Azure is right there capturing that massive shift. Now, the best part? Microsoft provides a really comfortable income floor because it trades at a reasonable forward PE right in the mid-20s, complete with a reliable, multi-decade dividend history. So you get all this incredible AI optionality without having to pay those absolute peak, purely speculative multiples. All right, part 3, Alphabet. This is where massive distribution meets accelerating infrastructure. Look, Alphabet is just firing on all cylinders right now, generating an astonishing $446 billion in trailing 12-month revenue. This isn't some scrappy startup hoping to find an audience someday. This is an absolute titan, using its unbelievable scale to deploy AI to billions of everyday users instantaneously. What they operate is a massive, self-reinforcing ecosystem. Generative AI, like Gemini, is now integrated across almost everything they do, from search right through to Android. They build their own custom silicon with TPU systems, they provide heavy-duty enterprise solutions through Vertex AI, and they continuously drive crazy efficiency in their advertising business. It is one powerful flywheel. And all of this is driving truly explosive demand. In fact, Google Cloud has reported growth rates exceeding 80% in some recent quarters. As businesses completely scramble for raw compute power and advanced models, Google Cloud is stepping right in to capture an enormous piece of that pie. Here is where it gets really interesting for patient investors. You get a built-in margin of safety because their trailing PE is noticeably lower than many of their big tech peers, sitting right around that 17 to 18 times range. Plus, they've recently initiated a dividend with a very low payout ratio, which leaves a ton of runway for future increases. Let's move to part 4, Broadcom, the foundational infrastructure engine powering the data centers behind these large models. You can think of Broadcom as the ultimate picks and shovels play of the current AI gold rush, with trailing 12-month revenue sitting around $75.5 billion, which, by the way, is a massive 30% jump year over year. They provide the highly critical custom chips and networking silicon that literally make these vast data centers function. As the go-to infrastructure specialist, they are riding this unstoppable tailwind of custom silicon and networking demands required to train these massive AI models. But here is the kicker. They aren't just hardware. They have a massive infrastructure software business that acts as a really powerful buffer, providing excellent diversification and steady recurring revenue. The scale of this explosion is just staggering to look at. Broadcom's AI semiconductor revenue has jumped over 200% in some periods. They are pushing toward a potential $100 billion by fiscal 2027. And this is being driven directly by the big tech giants spending billions upon billions to build out their AI capabilities. Now, sure, Broadcom carries a bit more volatility than a Microsoft or an Alphabet, but it also offers the strongest dividend yield of the trio. And because their earnings are ramping up so incredibly fast, their forward PE is compressing beautifully into the low to mid-20s over time. It makes for an incredible target to accumulate when the market goes through significant drawdowns. Okay, part 5. Let's bring this all together with our watch, not chase playbook for strategic, long-term execution. Look, while none of these stocks are dirt cheap by historical standards, their valuations are entirely reasonable when you factor in their immense cash flow and growth compared to purely narrative-driven stocks. We now have 3 very distinct layers of the AI stack: cloud, distribution, and infrastructure, all sitting at manageable valuations and all of them actively returning capital to you as a shareholder. So, how do we put this into practice? Just follow these 4 simple steps. Number 1. Set your strict valuation thresholds. Number 2, don't buy everything all at once. Scale into your positions gradually over time. Number 3, keep your eyes glued to the real fundamental data, like cloud growth and CapEx. And number 4, diversify across the stack so you aren't completely overexposed to just one layer of this technology. So as we wrap up this explainer, I want you to think about your own strategy for a second. Which of these 3 layers are you watching most closely right now? Are you leaning more toward Microsoft's enterprise stability, Alphabet's value cushion, or Broadcom's infrastructure engine? Drop a comment below and let me know. Remember, this AI build-out is a multi-year cycle. Patience and structure are going to be your absolute greatest assets. Keep learning, stay patient, and thanks so much for watching.